Welcome to Debt Matters. Imagine you're driving down a dark, unfamiliar road, and your dashboard warning lights suddenly begin to flicker.
Right.
Do you just slam on the brakes in a total panic?
Uh-huh.
Or do you maintain your speed while, paying much closer attention to the actual sounds of your engine?
You definitely want to just listen to the engine first.
Exactly.
Yeah.
And today, we're examining the February 2026 business insolvency figures for England, Wales, and the wider UK. Our mission for this conversation is to figure out which of those warning lights actually matter.
Yeah.
We want to understand the practical reality these figures paint for firms, suppliers, lenders, and of course collections teams right now.
Well, the raw numbers from February 2026 really set a clear scene for us. In England and Wales alone, 1,878 companies entered insolvency.
Wow.
Yeah. And when you zoom out to the national level, the total UK figure hit 2001. That is a jump of 162 insolvencies compared to the previous month.
Okay, but before we get entirely lost in the spreadsheets here, we need to establish the tone for what these figures actually represent.
Definitely.
If you're listening to this as a professional who, manages credit, chases payments, or balances a ledger, you already know the terrain.
Yeah.
These numbers absolutely do not call for panic.
No, not at all.
There's no need for dramatic reactions or, freezing all your lines of credit overnight. Instead, what we have here is a very clear, persistent prompt to examine why cash flow discipline matters every single day.
Right, because a slight rise on a spreadsheet does not mean the sky is falling. I mean, it's simply a reality check. Firms are operating in an environment where you just cannot afford to be lax with your receivables.
Yeah.
The goal here is steady, consistent vigilance rather than sudden alarm. You're looking for friction in the system before it becomes an actual failure.
Let's unpack that friction, actually, by looking at the month-over-month creep. Because moving from a raw total to the context of the calendar, that's where the real picture comes into focus.
Exactly.
If we break down that 1,878 figure for England and Wales, it is 7% higher than January 2026. But paradoxically, it's 7% lower than February 2025.
That presents a bit of a statistical push and pull, doesn't it? You have this short-term increase wrapped inside a long-term decrease.
Yeah, so think of managing a business's risk, like managing that vehicle's engine we just talked about.
Right.
Just because your engine's RPMs are running 7% lower than they were on this exact stretch of road a year ago,
Right.
you don't ignore the fact that the engine is sputtering noticeably more this month compared to last month. A 7% drop annually feels like a relief until you realize the intake valve is currently clogging up in real time.
Yeah, the fuel just isn't reaching the engine smoothly right now.
Exactly.
That mechanical view is really the best way to approach the data. We really shouldn't read that annual comparison too casually. Yes, the year-over-year number is technically lower,
Sure.
but 1,878 businesses entering insolvency in a single month is still a massive volume of commercial failure. While the totals might be lower than the heavier periods we navigated between, say, 2022 and 2025, they're not low in any absolute sense.
Right.
The baseline has fundamentally shifted upward.
But let me push back on that just a little bit. Is a single 1-month rise just statistical noise? Because if I'm running a busy collections team, I might look at a 7% bump from January to February and think, well, January is always a weird month for cash flow anyway.
True.
You've got post-holiday hangovers, quarterly tax obligations clearing out, delayed invoices. Should we really be adjusting our posture based on a single month's data?
I mean, it's a totally valid challenge. On its own, a 1-month rise does not mean the underlying economic structure has broken overnight. You don't tear up your whole collection strategy based on one isolated data point.
Right, that would be an overreaction.
Exactly. However, it absolutely sharpens the practical questions you have to ask your team today. When the overall number ticks up, it proves the pressure is building somewhere in the system.
It's that friction again.
Yes. It forces you to ask, which specific accounts have suddenly gone quiet? Which long-standing customers are subtly slowing down their payments? It validates the need to audit your ledger right now, rather than waiting passively to see what March or April looks like.
So if we accept that we can't just wait for the spring data to take action, our immediate problem becomes knowing who to target. If insolvencies are creeping up month to month, the next logical question we have to explore is how these businesses are shutting down.
Yeah.
Like, who is actually pulling the plug?
Well, the mix of insolvency types is incredibly revealing right now. Creditors, voluntary liquidations, commonly known as CVLs, make up a massive 78% of all cases in February.
Wait, 78% let me make sure I'm understanding this paradox.
Uh,
Because the data also shows that compulsory liquidations, meaning court-ordered closures, are actually down 35%.
right.
Shouldn't we be breathing a sigh of relief there?
Yeah.
Fewer businesses are being forcibly shut down by the courts. On paper, that sounds like a victory.
It looks like a victory until you realize why those court cases are dropping. The courts aren't shutting them down because the directors are beating them to the punch.
Oh, wow.
Yeah, that's where the 78% figure for CVLs comes in. A CVL means that company directors are taking the step themselves before a creditor forces them into a legal corner.
I see.
They're sitting down, looking at the books, realizing the business is just no longer viable, and throwing in the towel voluntarily.
So the lack of court cases isn't a sign of health at all. It's a sign of exhaustion.
Precisely. They're exhausted, or they're trying to protect themselves from wrongful trading accusations. Meanwhile, administrations are actually up 30% year over year.
And an administration is a very different beast from a liquidation.
Oh, very different. A 30% rise in administrations shows us that some firms are still actively trying to preserve value. Entering administration usually means they're deploying a legal shield to try and sell off assets, or maybe restructure the profitable parts of the business to keep a core entity alive.
Right, rather than going straight to a total closure.
Exactly. They're fighting to salvage the healthy organs of the business. But for the suppliers and unsecured creditors who are left holding the bag for the unhealthy parts, the financial loss is often just as severe.
You know, for a collector or a credit manager or a finance team, this breakdown completely changes the tone of the job.
How so?
Well, if 78% of these closures are entirely voluntary, it means your job isn't just about aggressively chasing a debt.
Mm.
You aren't just hammering the phone demanding payment from someone who's stubbornly holding out on you.
Right.
It's about reading the account properly. You have to understand the director's mindset before they reach the point of calling in an insolvency practitioner.
Yeah, you're managing human behavior and psychological endurance just as much as you're managing a balance sheet.
Exactly. If the director is the one most likely to pull the plug, you need to know where their head is at. Like, are they communicative? Are they actively trying to trade out of the hole? If a debtor is still trading, still talking to you, and still able to agree to a realistic payment plan, there's immense value in keeping that relationship workable.
And that brings us to the collector's tightrope. Knowing that directors are making these proactive, tough calls means creditors have to spot the trouble before the doors close. You have to identify the pre-insolvency period.
So what does that pre-insolvency period actually look like on the ground? How does the behavior change?
Well, a business rarely collapses without warning. There are behavioral signals. Payment promises start to slip.
Right.
A client who usually pays reliably on day 30 suddenly stretches it out to day 45 without explanation. Then you see administrative friction. Queries appear incredibly late in the process.
Like asking for paperwork they already have.
Exactly. They suddenly need a proof of delivery or a copy of an invoice they've literally had for 5 weeks. That is a classic stalling tactic to reset the payment clock. Or they might ask to make smaller part payments, or they request an open-ended extension without offering any clear schedule for when the balance will be cleared.
Here's a really practical dilemma, though. If you're listening to this and you oversee a ledger of, say, 500 active accounts, how do you distinguish between a client who is just disorganized and one who is genuinely in distress?
That's tough.
Because a disorganized, chaotic client might also lose an invoice and ask for a copy late in the game, right?
Yeah, that is the hardest part of credit control, and it requires finding a very delicate balance. Not every late payer is on the brink of collapse. Some are just poorly managed, or they're prioritizing other louder suppliers,
Yeah.
or maybe they're dealing with temporary cash flow friction because they're waiting on their own invoices to be paid. The defining test is engagement.
Engagement.
Yes. If a debtor is communicating transparently, explaining the friction, and agreeing to a realistic, measurable plan to catch up, you maintain the relationship.
But if they start dodging you,
That is when the tightrope gets very wobbly. If engagement drops and the excuses become vague, the warning signs are stacking up. And the timing here is brutal.
how so?
Push too early and too aggressively, and you ruin a salvageable relationship with a customer who might have recovered and been a loyal, profitable client for years.
You alienate them.
Exactly. But if you wait too long out of politeness, you risk becoming just one of many unsecured creditors. Once that director enters the CVL process, the window for a better outcome basically slams shut. You're at the back of the line, hoping for pennies on the pound.
It's a brutal balancing act. And it becomes even more complex when we look at the macro connection because, business struggles don't happen in a vacuum. We have to look at the people running these businesses and the people buying from them.
The consumer debt ecosystem and the business debt ecosystem are entirely intertwined. You just cannot analyze one without understanding the pressure on the other.
Let's bring in the individual insolvency numbers for England and Wales from the exact same February 2026 cycle. We're looking at 11,609 individual insolvencies.
Yeah.
That is 6% higher than January 2026 and a massive 18% higher than February 2025.
So while business insolvencies dropped slightly year over year, individual insolvencies surged by 18% in that same time frame. The pressure is clearly not sitting in one isolated sector of the economy.
Not at all. Think of a small business as an extension of a household ecosystem. For countless small and medium enterprises, the line between a director's personal finances and their business finances is extremely thin.
Oh, absolutely.
In many cases, it's virtually non-existent.
We see the reality of this every single day. I mean, imagine a director of a small local logistics company. On paper, his business might actually be breaking even, but in his personal life, his mortgage rate has just jumped, his utility bills are unmanageable, and his personal credit cards are maxed out.
Right, the personal strain is huge.
Right. And because of that, he has significantly less room to support his business. He can't inject personal cash to make payroll or bridge a bad month. Worse, he might start draining the business account to cover his personal life.
And suddenly he can't pay you, his commercial fuel supplier.
Exactly. That is what that 18% consumer insolvency spike looks like in reality. A director's personal strain becomes your business strain immediately.
And the mechanism flows the other way too, right? With the customer base itself.
Absolutely. Consumer-facing businesses suffer directly when their customers are forced to prioritize essential bills. If an individual is struggling to keep the lights on and they're entering a personal debt solution, they are not spending discretionary income at the local retail shop or hiring the local landscaping contractor.
Yeah, that revenue just dries up completely.
Exactly. When you see company insolvencies creeping up alongside a sharp 18% rise in individual insolvencies, it points to a much tougher, interconnected collections environment.
So, knowing all of this, the month-over-month creep, the high rate of voluntary liquidations driven by exhausted directors, the collector's tightrope, and the severe consumer strain. What is the playbook for right now?
That's the big question.
Yeah. With both consumer and business pressures mounting, what are the concrete, everyday steps you must take to protect your ledgers?
Well, the current backdrop heavily rewards rigorous, proactive habits over reactive panic. First, you must review your aging reports immediately.
Okay.
Look at the payment trends, not just the static balances. Where is your exposure? You need to understand your ledger by sector and by customer size. If you supply the hospitality sector, your risk profile is very different than if you supply corporate tech.
Let's talk about concentration risk for a second.
Yeah.
How does a business mathematically evaluate that danger today?
Concentration risk is vital to map out. You must give extra attention to any single customer that owes a disproportionately large share of the ledger. If your total monthly expected revenue is £100,000 and one single client owes $40,000 of that, they represent an existential threat to your own cash flow.
Wow, almost half.
Exactly. And if that specific client is showing those warning signs we discussed, late queries, slipping promises, that deserves your absolute immediate focus. You cannot afford to let that one account drift because if they file a CVL, they take you down with them.
Beyond just watching the reports, how do we practically tighten up the day-to-day operations?
You have to get the administrative basics flawless. Keep your terms crystal clear right at the start of the relationship. Invoice accurately and promptly. Follow up early. Do not wait until the debt has aged badly before you make the first phone call. And crucially, resolve disputes quickly.
Expand on that. How does a minor dispute turn into an uncollectible debt?
Well, distressed businesses look for legal cover to freeze payments. If a client disputes a minor £50 charge on a £10,000 invoice and your team takes 3 weeks to investigate and resolve it.
Oh, I see where this is going.
Right. That client now has a legally defensible reason to withhold the entire £10,000 payment for 3 weeks. You have just given a struggling business a free unsecured loan because your internal dispute resolution was slow.
That's a painful mistake to make.
It really is. Do not give a debtor the chance to weaponize a minor dispute as an excuse for non-payment.
That is a phenomenal point. I want to challenge the traditional way we manage these accounts, though. We constantly hear about segmenting the ledger. But if I'm just using the classic 30, 60, and 90-day buckets, that feels honestly practically useless right now.
It
A
is.
company can file a CVL on day 45. How should we be reorganizing our accounts to catch these closures before they happen?
You have to move from age-based segmentation to behavioral segmentation. High-risk accounts should not be treated the same way as your reliable ones, even if they're both 10 days overdue.
Makes sense.
If an account has a history of erratic payments or broken promises, they go into a highly escalated communication workflow. They get contacted sooner, they get zero leeway on extensions without proof of funds. You allocate your most experienced team members' time to the accounts where the behavioral risk of insolvency is highest, rather than just working down an alphabetical list of 30-day overdue accounts.
That makes total sense. You wouldn't use the same gentle automated template email for a client who is 2 days late versus a client who is 40 days late and suddenly ignoring phone calls.
Exactly. And this brings us to a critical messaging point, especially for debt collection agencies and in-house recoveries teams communicating with their executive boards or their external clients. In a demanding market like this, clients do not just want you to demonstrate chasing activity.
Right.
They don't just want a report that says, we auto-dialed this debtor 10 times today. They want judgment.
Judgment versus activity. Give me a concrete scenario of what good judgment looks like compared to bad judgment.
Sure. So bad judgment is taking a rigid, automated approach to a struggling retail director. You auto-dial them every morning, demand the full balance, and threaten legal action.
Which probably just pushes them over the edge.
Exactly. The director gets overwhelmed, sees no way out, and files a CVL. You get nothing.
In good judgment.
Good judgment is recognizing the distress, engaging the director in a real conversation, and realizing their cash flow is entirely dependent on weekend sales. So you restructure the payment plan to collect smaller weekly amounts every Monday morning, directly aligning with their weekend cash register receipts.
That's brilliant.
You keep the business breathing, and you actually recover the debt. That is judgment.
It's about reading the weather on the ground, not just looking at the thermometer in the office.
Exactly. That is why tracking these February figures matters so much. Not because one monthly total dictates the economy, but because it helps businesses judge exactly how firm or flexible they need to be in the weeks ahead.
Yeah.
And remember, that UK total of 2001 company insolvencies shows this fits a wider national pattern. It is not an isolated event in one specific region or industry. Businesses everywhere are dealing with a demanding, low-margin trading climate.
Let's bring all these threads together. We started by examining the February 2026 figures, 1,878 insolvencies in England and Wales and 2001 across the wider UK. We saw a 7% month-over-month rise, demonstrating that the pressure in the pipes is increasing right now.
Right. And we established that while overall historical levels might have shifted, a single month producing nearly 2,000 commercial failures is a stark reminder to keep your guard up and audit your ledger today.
We also looked at the reality that 78% of these closures are creditors' voluntary liquidations. Company directors are making the hard call themselves.
Yeah.
Which means your primary job is to understand their mindset, identify their exhaustion, and engage with them before they make that final call.
And we connected the 18% rise in individual consumer insolvencies directly to the business landscape, proving that financial strain is bleeding across the entire economic ecosystem, from the household mortgage to the commercial supplier.
The practical takeaway for you today is clear. If you manage receivables, review your ledger right now for behavioral red flags, not just aging balances. If you work in collections, prioritize judgment over sheer activity.
Absolutely.
If you run a business, do not let overdue accounts drift longer than they should while you resolve minor disputes. The February figures do not call for panic, but they absolutely mandate a more disciplined, watchful approach to credit control.
Yes, they do.
If a customer's communication pattern changes, reassess your risk immediately, rather than just resending a generic reminder. Keep watching the patterns build over time.
The environment demands focus. Those who apply consistent, sharp judgment will navigate this effectively, keeping relationships intact while protecting their own cash flow.
As we wrap up this conversation, I want to leave you with a final thought to mull over regarding your own accounts. We talked a lot about engagement and how to spot a debtor who is spinning a story versus one who is genuinely trying to pay.
Right.
But consider the concept of the silent debtor. If communication is the absolute lifeline of commerce, what does it mean when a normally highly communicative client simply stops asking questions, stops complaining about minor issues, and just goes entirely quiet.
It's a great question.
Is silence actually the loudest red flag in credit control? Something to think about the next time you look at your aging report.